conference will now be recorded.
Yes, one of you just unmute and say me hello.
Hello, ma'am.
I think your voice is appearing very low to me. Arnie, just hold on. 1 second. Sounding very low. Yes, Arnie, speak up.
Am I audible, ma'am?
Arnie, are you speaking up?
Yes, ma'am.
Yes, now?
Yes, ma'am. Am I audible?
Faint voice is coming. It's not that high. Very low voice.
Can someone else speak up?
No, I know I'm able to hear, but it's very low voice actually. 1 second. Just speak up now.
Yes, ma'am.
Now again.
Yes, ma'am. Can you hear me?
The voice is in a faint. It's not that loud. Fine. Okay, another 2-3 minutes. Let everyone join the session. I'll just make some arrangement. After that, just hold on. I'll put off the screen. Hello. One of you just unmute yourself and just speak up a few words.
Your voice is a bit further away, ma'am.
Say something. Yes, anyone? Nikita, Brenda, just unmute yourself and just pick up a few words.
Is it audible now, ma'am?
हाँ एक ಬರ್ತಾ
म्यूजिक क्यों ना बरता था? हाँ. Yes, Brinda, you can just unmute yourself and talk again.
Yes, ma'am. Is it audible now?
Yeah. Okay, ma. Thank you. Right, pa. So I've already shared the screen with you. Okay, are all of you there in the income statement which we had left yesterday?
Yes, ma'am.
Yeah, pa. So were you able to solve the P&L one? Did you get your EAT, or you saw and you solved it? Yes. So
Ma'am,
what was it?
I
Yes,
don't
ma.
know I don't know what to do, ma'am. I did something, but I don't know what I was doing.
Fine. Anyways, I'll be there here to guide you, of course. But voluntarily, were you able to make a try, or did you see the solution and then tried it? Was my question. Okay, so it's a very simple one. Okay, so now here, as I've told you, you have to prepare a multi-step income statement for the Apple company, which is a clothing retailer. Okay, for the year ending, we have got the list of expenses. Okay, primary, secondary expenses, as well as the other transactions. So all these entries we are going to put up in this table which you're seeing on the right hand side, and you're going to arrive at the profit after tax, the net profit available. Okay, so here what you're supposed to do and how you're supposed to start is, now first you have to arrive at your, what do you say, your cost of the goods sold. Now how do you arrive at the cost of the goods sold? What formula do we use to arrive at the COGS? It is
Beginning inventory plus purchase minus ending inventory.
correct. Opening stock plus purchases minus closing stock. Correct. So this formula we are going to use to compute the cost of the goods sold. So first let's do that homework first. Now here again, I'll just show you here. So if you have to compute the COGS, yeah. So your COGS equals to opening stock. So your opening stock, can you see here we have beginning inventory. After advertising expenses, you have beginning inventory. So beginning inventory is 2,56,000. So it has to be opening stock, which is 2,56,000 plus purchases. So your purchases, material purchases, what you're seeing here is your total purchases for the company. Now, which are the expenses which we're having? Advertisement expenses, beginning inventory, nothing but your opening stock, then depreciation, fourth, ending inventory. Ending inventory means closing stock, closing inventory, all are same. Then gross sales, interest expenses, lease payments, management salaries, material purchases. That is the total purchases made by the company for the year. R&D expenses, repairs and maintenance expenses, returns and allowances, and finally we have taxes. Okay, so first job is to find out your COGS. So 2,56,000 is your opening stock plus purchases. Material purchase is the purchases made by the company. So material purchase is 24,25,000. So 24,25,000 minus closing stock. Ending inventory is your closing stock minus 2,48,000. So what should be the answer? Your COGS. I've given the calculation here. Opening stock plus purchases minus closing stock. So what answer you get as COGS? Because first you have to do this and then the rest. So you should be able to get 24,33,000.
Ma'am, it is 24,33,000.
Yes, ma'am. So it has to be 24,33,000. Okay. So this is the answer for your cost of the goods sold. So let's structure this income statement now. So first is you have to place your gross sales. So what's your gross sales? Your gross sales is 32,10,000. So your sales comes up to 32,10,000. Gross sales and then cost of the goods sold, your COGS. So your COGS will be a deduction from the gross sales. So gross sales minus COGS will become your gross profit. Okay, so sales minus cost of goods sold is nothing but your gross profit. So your cost of goods sold is how much? 24,33,000. So 24,33,000 becomes your COGS. And then sales minus cost of goods sold becomes your gross profit. So gross profit is what? Equals to sales minus cost of the goods sold. So it has to be 7,77,000. So this should be your gross profit. So sales already it has been posted here. Your gross sales is 32,10,000. Your cost of the goods sold is as calculated here 24,33,000, and sales minus cost of goods sold you arrive at the gross profit, which is like 7,77,000, which you've already done here. Remember this, which we had computed. This one, sales minus cost of goods sold will become your gross profit. I hope all of you have got 7,77,000 as a gross profit.
Yes, ma'am.
Yeah, good. Now we have arrived at the gross profit. Next, what step we have to take? We have to subtract the expenses from the gross profit to arrive at our earnings before interest, tax, and depreciation. In the sense, we have to subtract or deduct all the operating expenses which are incurred by the company from the gross profit. I'll repeat again, we have to deduct or subtract our operating expenses incurred from the gross profit, okay, to arrive at the earnings before interest, tax, and depreciation. Okay, so which are all the operating expenses that we have to sum up here? So which are all the operating expenses? We'll just list out here. Now basically, what are operating expenses? Can anyone define, or have you heard what are operating expenses?
Ma'am, they are
Any
expenses
expense.
expenses made while for the daily working of a business, ma'am.
Yes, daily working of the business, which are routinely incurred. Routine, it can be day to day, every month, every week. So they're all routine expenses which are incurred by the company for the to conduct the daily operations or the daily activities. Okay, but if I talk about depreciation, what kind of an expense is depreciation as per you? Is it classified as an operating expense, your depreciation?
No, ma'am.
Then
Non-cash
very good.
transaction, so it's not considered as operating expense.
Then what? Then how is depreciation classified?
In reporting, it's put under administration expenses.
Okay. So your depreciation is a non-operating expenditure. Depreciation is non-operating indirect expenditure for the company. So I've told you in very simple words, because depreciation cannot be incurred on a routine basis, okay, on a day-to-day basis. So it cannot be declared as an operating expenditure. Rather, it will be classified as a non-operating expenditure for the company. Okay. Now let's start, okay, listing the operating expenses which are incurred by the company in the list which I have given here. Now, the first and foremost, we have advertisement expenses. So that will be considered as the operating expenses. So just put up as advertising. And what is the amount here? 68,000. Next, as I've told you, we can't consider depreciation. Next, we have this interest. So interest we cannot take, okay, as a routine expenses. We'll come to the lease payments. So lease payments comes up to 52,000. Next, salaries, management salaries. It is 2,40,000. Next is R&D expenses. It comes up to 35,000. Next, repairs and maintenance expenses. Comes up to 22,000. Next, returns and allowances. $48,000. Okay. So these are the list of operating expenses. Put it in some other color. So now you have to sum up these operating expenses. Okay. So here what you're supposed to do. So total operating expenses. So what, how do you compute? Equals to sum, calculate the total. So 4,65,000 has to be your total operating expenses. Okay. So then you have to arrive at earnings before interest, tax and depreciation. Nothing but EBIT DA. So how do you go for it? Here, gross profit minus, or I put it in this way, this is your EBIT DA. Okay, so what is your EBIT DA stands for? EBIT DA stands for earnings before interest, tax and depreciation. This is EBITDA, earnings before interest, tax and depreciation, the full form of it. So how do you arrive at your EBITDA? What is the formula to compute your EBITDA? It is nothing but gross profit minus operating expenses. This is the formula to compute your EBITDA, gross profit minus operating expenses, equals to, what's your GP? 7,77,000 minus operating expenses of 4,65,000. So 3,12,000 should be your EBITDA. And from that, one by one, you're going to subtract to arrive at the net figure, which is your EAT or PAT. EAT stands for earnings after tax, PAT profit after tax. Okay, so how do you arrive at that final figure? Now in your EBITDA, what I've given here, the abbreviation, which comes first for you? Interest, tax and depreciation. First comes is your interest. So what you're supposed to do is take the interest expenses. So what's the interest amount? Interest expenses 64,000. So 64,000. So you have to minus this 64,000. Okay. So after you minus your interest, you arrive at earnings before tax and depreciation, EBITDA. This, like this, you're supposed to do it. Now in this case, I'll make a small change. Now you can subtract the interest expenses 64,000, then arrive at the EBITDA, or you can first subtract your the last point, which is your depreciation, and then you can consider your interest expenses and tax. In however way you do, you arrive at the same answer. Okay, so what you can do is either you can structure your earnings like this, otherwise there's an alternative where you can do it in this way and arrive at your EBIT. You can first subtract your DA, nothing but your depreciation. So what's your depreciation amount? Your depreciation amount amounts to 78,000. So your EBIT equals to EBIT DA minus 78,000. So your EBIT comes up to 2,34,000. Then from this EBIT, you have to take your interest. How I consider that time? The same way. So what's the interest expense? It is 64,000. So after you subtract the interest expenses, it comes up to EBT. So which is nothing but equals to 2,34,000 minus 64,000. So it comes up to 1,70,000. So EBT is nothing but earnings before tax. So now you have to subtract the tax element. So how much amount is the tax? It is 51,000. So you're arriving at the final figure, which is your EAT or PAT. Okay, which is equals to EBT minus tax, 1,19,000. So which means your EBITDA I have given here, your EBIT equals to EBITDA minus depreciation. And then EBT equals to EBIT minus interest. And then EBT, EAT or PAT, which is EBT minus tax. This is the way you are going to arrive at your earnings after tax or profit after tax. So I put up the table for you. Hope it's clear.
Excuse me, ma'am.
Yes,
Ma'am, what is the formula for EBITDA?
EBITDA. EBITDA I've given you. See, EBITDA is gross profit minus operating expenses.
No, ma'am, after the depreciation,
Ah,
what is the one we are going to take there?
I didn't get your point.
After the depreciation, ma'am,
EBI.
what is
When you subtract depreciation from the EBITDA, you get EBIT. So EBITDA minus depreciation, you'll get EBIT. See, I've just elaborated here how do you get your EBITDA, EBIT, EBT, and finally EAT. So you can just look at this formula and you can just look up the table here. So you get the idea of how it is how it has been worked out.
okay, ma'am.
Yeah. you have any doubts, you can raise your doubts. Yes, are you done?
Yes, ma'am.
Okay. Fine. So we have the P and L too. So if you can just make a try, or just look at the statement and any idea how you can go about it. It's a very simple case schedule. So I hope you can make a try. Or 5 minutes, you can just observe the case.
Excuse me, ma'am.
Yes, ma'am.
Ma'am, could you go back to P&L one, ma'am, and go to the beginning for a minute?
Yes, yes. I've gone to this previous sheet. You're still working on that?
Could you scroll up, ma'am? Yeah, scroll up. Thank you.
Okay. If you're still working on the P&L one, I can give you time another 4 minutes. If you have done working, then I'll start with the P&L two. Have all of you finished working on P&L one? Okay. So I assume that you have finished with the working on P&L one. Now I'll start with the working of P&L two. Yes. So please, for a couple of minutes, 2 to 3 minutes, just go through this assumptions, and why don't you make a small, thinking of how to complete this income statement. Later on, from my side, I will definitely guide you It's a very easy one. Already you have worked on all these things in the previous cases of your income statement. So 2 to 3 minutes, you can take time. You can understand how it has to be sorted out. It's a very easy one. You can hardly take 5 to 10 minutes. Yes, are you able to make some idea of how to solve this? You have your initial sales volume in terms of units. So around 10 lakh units have been, 1 lakh units have been sold, okay, at a price of 125 per unit. The cost price per unit is 75. The selling price is 125. Each year, there is an increase in sale by 15%, as well as there is an increase in the cost of the goods sold by 20%. So how do you compute this income statement? How do you complete this income statement? So here, for year one, what's your sales? Equals to 1 lakh into 125. 1 lakh into 125. Number of units sold into selling price per unit for the first year. So you get around this amount. Okay, 1 crore 25 lakh. Or 125 lakh. Now, how do you arrive at the COGS? Equals to, okay, what is the total number of units sold? 1 lakh. What is the cost price per unit sold? It is 75. So the total number of units sold in the first year is 1 lakh. And what is the cost price for one unit sold? It is 75. So your COGS is 75 lakh. How do you arrive at the gross profit? Sales minus cost of goods sold. So 125 lakh minus 75 lakh. So for the first year, this is the amount you're going to get as gross profit. Next. What is the selling and administration cost? It is 25%. 25% of what? You can just bring your cursor near to the arrow. So just given as a information here that your selling and administration costs are 25% of revenues for that year. I'll repeat again. Your selling and administration cost, nothing but your operating expenses, will be 25% of revenue. What does 25% of revenue means? 25% of your sales for that year. So what amount we get as sales for that particular year, for the respective year, multiplied by 25%. That will become your selling and administration cost. I'll repeat again. Your total sales revenue into 25% becomes selling and administration cost for that respective year. Okay, so equals to sales into 25%. So this has to become selling and administration cost. So what's your EBITDA? Equals to, how do you get your EBITDA now? Gross profit minus your operating expenses. So this is how you arrive at your EBITDA. Depreciation has already been given, which is 2000. So you need not worry about depreciation. So how do you come to EBT? Equals to EBITDA minus depreciation. So you get 18,73,000 as EBIT. Again, interest has also been given. Interest expenses. How do you arrive at the EBT? EBIT minus interest. So you get 18,71,500 as your earnings before tax for year one. And how do you compute tax? It is the rate is 30%. 30% of what? 30% of EBT. See, tax rate is 30% of earnings before tax for that period, just similar to your selling and administration cost. So equals to EBT into 30%. Yeah, it comes up to this amount. It's 5,61,450. So how do you arrive at your PAT, or the net income or earnings after tax? Equals to EBT minus tax. Yes. So this is how you're going to arrive at your PAT. So I hope for year one it's very clear. Now for year two, what has been told here? Each year revenue increases by 15%. So for every year there's an increase in revenue by 15%. So how do you compute the sales revenue for the year two? How will be your calculation for year two?
Ma'am, first year amount plus 15%.
First year amount plus
15%.
I got the same answer. All this you have worked out in the previous case studies. Remember and tell me.
First year's amount, bracket 1 plus 15%.
Previous year amount bracket 1 plus 15%. Mm-hmm.
Previous year amount into bracket 1 plus 15%.
Very good. Everything matters in your Excel. Equals to previous year sales into, open the brackets, 1 plus 15%, close the brackets, and then press enter. Yes, got it. Same thing with your COGS. Equals to COGS of previous year into, open the brackets, 1 plus, it increases by 20%. So 20%, close the brackets. And once you do it for the second year, make out for the third year and the fourth year. And then the same. So you're going to complete this table now in a matter of few minutes. and arrive at your PAT or the net income. Come on, complete the table.
Done, ma'am.
Yes. All of you are done? Another 2 minutes I'll give you in case if you haven't done, you finish it off. Then later on, we'll go with the new concept. So this is the answer you have got. All of you?
Yes, ma'am.
Okay. Fine. So we come to the end of your income statements generation. Okay, so I'll just send one file across. Okay, in your WhatsApp web. Just give me a few minutes. Okay, you can be online. So just give me a few minutes. I'll send the file shortly to you. One file has been shared in your WhatsApp, so you can just open that file. I hope you've got that file. Yeah, just confirm. Have you got that
Yes,
file?
ma'am.
Yeah, just open that file. And you go to the first sheet, BS1. Go to the first sheet, BS1. Yeah. Please go to the sheet which I have shown you on the screen. So now you have to solve this balance sheet. So the simple balance sheet which I have given you, you have to place, okay, here everything, and this is an automated one which you're going to get. It's very simple. You're just going to observe how the placement is being done and just place the amount over there. So here, as you know, liability plus owner's equity becomes your assets. Okay, so your assets should match with the liabilities of the company. So only then your balance sheet gets completed and it is completely balanced. So here, if you see under the liability side, we have the accounts or the bills payable and the loans payable. So here I'm going to put across the amount is 50,000. My loans payable will also come under the current liabilities of 1,25,000. So my net liability equals to sum 50 plus 1,25,000. Next, I step on to the owner's equity equals to 1,20,000 retained earnings 6 lakh. So total owner's equity is 1,20,000 plus 6 lakh. So what should be your total liabilities? Okay. So it should come up to so this you can do it in any way. Okay. You can just drag it or you can just work it automatically. Once you can take this, you can also do it in this way or you can also work it on directly. So you should be able to get 8,95,000 as your total liabilities. Coming to your total assets, cash 35,000 equals to land 1,25,000, building equals to 4 lakh, other assets 10,000, stock, your inventories 35,000, equipment, accounts receivable. That's all. So your net assets or total assets is sum yes. So you're balancing both your assets and liabilities. So hardly it will take 2 minutes of yours. You can just complete this simple balance sheet.
And ma'am,
Okay. Okay, so you can just go to BS2 now. I hope all of you are done. Just go and to BS2, balance sheet 2. And you can just make a try. See, here I've just given you around 4 transactions. Okay, so with with the help of these 4 transactions, you're supposed to complete the balance sheet. So try to make a try. First, you are going to solve the income statement. Please don't do it simultaneously. First, solve the income statement and please give me the profit earned in this case study. Then I will solve it. Yes, are you able to get the profit from the income statement? Yes, you're able to hear my voice?
Yes, ma'am.
Suddenly got disconnected. Yes, ma'am. Yeah, were you able to get the answer for the income statement? None of you?
No, ma'am.
No, you didn't even make a try. So how
Ma'am,
you?
I,
Yeah. Ah.
I
Ma'am, there is no profit. I did not get any profit because sales and cost on goods sold are the same.
How can it be the same?
Because here we've sold like 50 books for 200 each, that is 10,000, and we
Hmm.
have bought 100 books for 100 each.
Hmm.
That's also again 10,000.
Okay.
So sale is 10,000. Cost on goods sold is also 10,000. So profit is.
1 second. 1 second. Yeah, 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 yeah.
Profit is 5,000.
So how you got 5,000? So what is your sales? Equals to 50 books you have
Sales
sold.
equals to 10,000 now, ma'am.
50 books you have sold at 200 per book.
And COGS is 5,000. So
So your cost of the now out of 100 books bought, how many books you have sold? But it is very easy.
50.
Total
50 books now.
correct, right? So out of 100 books bought, 50 books are sold. So what is the cost of these 50 books? It is 100 per book.
100.
15.
Hmm. So your profit is 5,000. How can it be zero? See, Pa, clearly understand your COGS concept. COGS means what? See, it's very easy to understand. Don't get confused. On 11th January, 100 books were bought, priced at 100 per book. Now, you yourself imagine you have a business, you have a stationery where you deal with the stationery items. You purchase 100 books from your supplier, he charges you 100 rupees for one book. Okay, you receive 100 books at your place. Now out of 100 books, you are selling 50 books, and you are selling these 50 books at a price of 200 for one book, but you purchase at what price? 100 rupees for one book. Now coming to your income statement, what is your total amount of sales? Total books sold is 50, so equals to 50, and sold at what price? 200 per book. So 50 into 200, 10,000 becomes your sales. Now what was the cost of these 50 books? The cost of these 50 books was 100 per book. So it was priced at 100, but I sold at 200. So 100 is a profit margin, huh? So which means profit becomes 5,000, which is sales minus your COGS. So you cannot get zero, yeah. It is 5,000. You're going to get the profit. I hope it's clear. Still, any confusions are there with regard to COGS? And sorry, profit. COGS and profit literally.
No, ma'am.
Hmm. Yes, ma. Tell me.
No, I told there was no doubt, ma'am.
Yes, but tell me. Ask me. Be free. Ask.
No, ma'am.
What's your
No, ma'am. I told there was no doubt, ma'am.
no doubt? Okay, okay. Oh, I heard that you had a doubt. Okay. So I hope it's clear. This is how you're going to compute your income statement. It's very clear. So now coming to your balance sheet, how you're going to complete this balance sheet is a nice calculation which you're going to work out. So carefully understand your balance sheet. Now, under liability side, the first part what you have is your accounts payable. Accounts payable is what? You have made a purchase of 100 books priced at rupees 100 per book, and this amount is not paid immediately to the supplier. It is paid after 30 days. Please look on to the 11th January transaction. Buy 100 books worth 100 per book, amount paid after 30 days. Amount paid after 30 days, which means the settlement is not yet made to the supplier. It is yet to be paid to the supplier, which becomes your accounts payable or bills payable. So equals to how many books were purchased in total? 100 books, priced at 100 per book. So this 10,000 is the total amount to be paid to the supplier. It is not yet clear. It is pending. So after 1 month, I'm going to clear his bill. So 10,000 becomes your bills payable. Now, coming to your equity capital. Equity capital is right away here for you. What is the capital introduced into the business? The total capital, owner's equity. 1 lakh capital was introduced into the business on 1st January 19. So equals to 1 lakh. So on your liability side, you should be able to get 1,15,000. Now coming to your asset side. One second. Yeah, I think this will be very clear for you. You can view everything. Coming to your asset side, we'll talk about the cash later. Cash will come at the last stage. Okay, I will complete from the other assets from computer till accounts receivable, then we'll come back to the cash. Now, coming to the computer, on 6th January, computer worth 20,000 was purchased. Okay, so equals to 20,000. 20,000 worth computer was purchased. Now you tell me, you have worked on a cash flow statement. What is a cash flow statement? It is a summary of cash inflows and cash outflows. So what is cash inflows? The source of business income, the receipts for the business. What is cash outflows? Where we are going to pay off our expenses, where the funds are going out of the business. Right? Now, if we are purchasing computer for the business, is it a cash outflow or is it a cash inflow for the business?
Cash outflow.
Very good. So it's a cash outflow. Cash is going out. So what you're supposed to do is come to the cash column against your computer equals to minus 20, because 20,000 is going out. Only when I spend 20, I'll get a computer. So funds are going out of my company. So it will be equals to minus 20,000. Like this, you're supposed to put equals to minus 20. So 20,000 is moving out of my business so that the computer comes into my business as an asset. Second, advance rent paid. Advance rent paid is 10,000. Now, outstanding expenses becomes your what? Liability. Prepaid becomes your assets. So you're paying rent of how much? 10,000 you're paying rent. So you are spending an amount of 10,000 as an advance for the rent. Now again the funds are going out or coming in. You're spending 10, it is going out. Equals to minus 10. Next. Deposit paid 20. Same treatment. 20 equals to minus 20. Next, inventory. Inventory you have to be very carefully understand. Now I'll come to the 11th January transaction. On 11th January, 100 books were bought. Out of 100 books, how many books are sold on 16th? 50 books are sold. I'll repeat again. On 11th January, 100 books are bought. On 16th, out of 100 books bought, 50 books are sold. So how many books are remaining in your
50.
50 books, correct? So equals to 50. And how do you price these 50 books? At what price do you uh, place them in the
100.
balance?
The purchase
Very,
price 100.
very good. It is into 100. So your inventory value becomes 5,000 by the end of your period. So inventory is 5,000 equals to 50 into 100. 5. And for this, there is no inflow or outflow of cash. It is the unsold, the closing stock. So here there is no cash treatment for this. It cannot be done also. The last one, accounts receivable. What is accounts receivable? receivable. We have sold 50 books on 16th Jan, priced at 200 per book, amount to be received in 30 days, which means the moment I have sold 50 books, I have not received the payment. Payment is yet to be made by my customer. So what it becomes? It becomes your bills receivable or accounts receivable. So equals to 50 books are sold, priced at 200 per book. So this much is yet to be received from my person. So 10,000 becomes your BR. This again cannot be posted here because there is no cash inflow or outflow. It is pending. So the final amount is, how do you arrive at the net cash? Now I'll come back to this. What was the total capital introduced into the business? 1 lakh. So now this 1 lakh, what capital was introduced? Is it an inflow or an outflow of cash or funds?
Inflow.
Inflow.
Very good. Very good. So 1 lakh here. 1 second. Equals to 1 lakh. Okay. Now this, I've put here 1 lakh. But this 1 lakh, what you're supposed to do is you have to post it on this side. What 1 lakh as capital I've given here, this you're supposed to post it this side and see what happens now. You got it? So 1 lakh is the cash inflow and all these become outflows. So 1 lakh is the inflow. 1 lakh minus 20,000 paid for computer, 10,000 advance rent paid, 20,000 deposit paid. So remaining how much I'm having in hand? It is 50,000. So balance amount of cash is 50,000 and this will be transferred here. So your net balance or closing balance of cash is 50,000. And there you're going to complete your balance sheet. So carefully you have to solve this balance sheet along with your cash balance at the end of the period. So complete this balance sheet now and then we'll close off your class. In tomorrow's class, we'll start with the debt schedules again and then with the accumulated depreciation chart.
Ma'am,
Yes, ma'am.
what will it appear if we have already received the amount? Like it is their amount received in 30 days. So what if it is already received, like the customers are paid, what will it appear in the balance sheet?
In balance sheet, it will not appear here because balance sheet does not have, see, what is your accounts payable and accounts receivable, which is yet to be paid or yet to be received. If it is already received, first you'll treat your cash account, no? Your first you'll treat that payments and receipts in your CFS as well as your profit and loss statement. There you have all your adjustments. Then your balance sheet comes. You're going to adjust everything in your prior statements, your trade, your what do you say? Your entries, then followed by your ledgers. All your cash adjustment is done, and the net figure is displayed in the balance sheet. So your if it is already paid or received, it will not appear in the balance sheet. It cannot appear at all. Only outstanding, prepaid, advance paid, advance received. Only such kinds of adjustments you see in the balance sheet. Is that clear?
Yes, ma'am. Yes, ma'am.
Yeah. Yes, have you completed the balance sheet?
Yes, ma'am.
Fine.
Yes, ma'am.
Very good. So hope the concept is clear now. Like how do you prepare the balance sheet practically in your FM? Because all these are building blocks for you to start your case studies in the coming days. So the days are approaching near, right? So we'll meet up in tomorrow's class to start with your debt schedules and your accumulated depreciation charts. Until then, keep up your practice going on. So see you all tomorrow. Thank you.